our session of Ab India Karega Invest. Today we have Mr. Atul Bhole with us, who is the SVP and Fund Manager at DSP. The session today is all about how we can develop a framework for investing. So investing in itself is, many people actually talk of the different tools that investors need and different things that they need to look at and so on. But investing as itself has to be it has to fit a larger framework. It's a larger structure. It's not just attacking individual approaches and individual tasks. So that is what we have Mr. Atul with us here for. So Mr. Atul, all yours.
Thank you, Shikhar, and thanks for hosting me on this evening. And welcome to everybody from the DSP Mutual Fund also. So I got this opportunity to explain my framework, and I think I will be using a small PowerPoint presentation for that. I will just share that with you. But we have started doing this attempt to explain the framework or the thought process of fund managers to the investors upfront, so that there is clarity in the investment decision making basically the kind of stocks the fund manager usually buys in his fund. So that's where we will start. Every person, or for that matter, every fund manager also has a particular line of thought process or framework in place, and he goes with that framework. So it is very important to stick with that framework because I believe that every person can have a mastery in one area or at the best two areas, and so it is important to go deeper into that kind of thought process or area of expertise rather than trying to attempt various styles of investment. There are many styles of investment. Two popular styles are basically growth, and the second one is value. In the growth investing style, people usually try to find or stay invested into growing companies. For them, growth is very important. And in this case, people also further go into two sub kind of styles like GARP, growth as reasonable price, or in some cases, valuations are sort of ignored or taken into stride. So that is one. Second is value, where the investors typically go for stocks which are trading at lower multiples. So they try to find comfort or margin of safety into valuations rather than business. So there are here also there can be further subsectors or further sub styles when you go deeper into this. So I think it is very important to understand what kind of fund manager you are backing, what kind of fund you are investing into, so that there is alignment of interest when the fund manager invests, and what kind of returns the investors can expect from those kind of schemes. Also, frameworks are very important because, as I said, one can have expertise in one or two areas, and if he tries to capture all trends in the market, so market goes through a cycles always. Sometimes growth stocks do well, sometimes value stock does well. But if somebody tries to capture all those styles or trends in the market, there is a very high probability that he will make mistakes, and in that process, the overall return of the scheme over a long period of time gets compromised. So it is always better to stick to one particular style to a large extent in the portfolio rather than trying to be master of all things, which actually never plays out. Also, another thing is basically when you have an investment framework written, it basically brings a lot of discipline in your decision making. Again, market goes through cycles, and there are episodes of greed and fear. In other words, there are peaks and bottoms in the market which keeps on happening. So if you have an investment framework, you can tackle with these greed and fear episodes in a much better way. When markets is going up, momentum style is in place, and people tend to chase those stocks, and ultimately one day comes when they got stuck into such momentum stocks, etc. And similarly, when the market goes down for whatever reason, at the bottom, if they don't have any particular framework or they are not they don't have conviction in their framework, they tend to sell out in those markets. Even good stock, they tend to sell out at such bottom prices. So with a good framework in place, we can tackle these episodes of greed and fear in a much better way, rather than again trying to be reactive. So in market, it is very necessary to follow a discipline, follow a framework, and stay invested rather than reacting to whatever news and events keep on happening, and reacting to the stock movements. That is a sure recipe of not making money or actually losing the capital in the market. So I think from that perspective also, having an investment framework thought process is very important, and obviously following that is much more important, because one can write paper or note, but if he doesn't follow that in practice, it is of no use. So I think these two things are very important, and framework helps in that way. So how one can develop the framework? Basically, it is very important to first understand your own nature and understand the expertise where you can make money. That is very important before developing a framework or starting to follow a framework. One has to have a self-conviction in the thought process. Obviously, with that thought process and the stock selection, we can backtest and whether you can look at those in those backtest, you have outperformed the markets or not. So that is the first step, that you should look at basically your thought process, conviction in that thought process, and also whether it is backed by the historical performances through backtesting, etc. So that is very important, and that helps a lot in developing a framework. So we'll go to now the investment framework which I have. So as I mentioned, there are various investment frameworks like growth and value, and there are people mix up that also. So I would call my investment framework as a quality and growth kind of companies. So for large part of my portfolio, say 85% of my portfolio, I like to invest into companies which are very strong franchisee, means they are very quality businesses, and there is a good visibility for growth for next many years. And generally, I look at these three things. These are very important things: business, management, and growth. In short, I call them BMG. These are very important things, and as you can see, there is no column for say valuation. So as I mentioned, some people look at valuation as the last parameter to judge any stock. So in my case also, for me, the business has to be good, management has to be very good, and there should be a growth visibility. And in that case, if I find such company or business, I can take valuation risk, and I will explain why it sometimes pays to take or assume slightly higher valuation risk, or buying slightly expensive stocks also, why it pays. So when I say business, I typically look at the opportunity set. It has to be a large opportunity set where the company can continue to grow for long period of time. That means there should be a conviction or confidence on the compounding of the company, which the company can offer. Because we have seen that these kind of consistent compounding companies only create wealth for shareholders. So having a large opportunity set is very, very important. We have examples in India in case of say banking and finance sector or consumption companies, etc. Because they have large opportunity set, the opportunity set itself keeps on growing, and on top of that, these companies grow at slightly higher rate than the market growth. So that's how they are getting those 12, 15, 20, 25% kind of compounding, and those stocks or companies have created a lot of wealth for the shareholders. Second aspect, obviously, to judge a business is basically to look at the market share dominance, or whether the company is gaining market share. These two things are very important to make money from that business. Obviously, market share dominance over a period of last, say, maybe 20, 30 years, if the company is continuously increasing market share, they become so dominant that they can exercise huge pricing power. They get a lot of operating leverage in the sense of bargaining better with their vendors and suppliers. Having a better scale helps them in allocating better sort of advertising and promotional expenditure over a large base. So all these things goes into higher margins for these companies which have dominant market share. And also when some kind of incident happened, like we have seen in last 3-4 years, demonetization, COVID, GST implementation, we have seen that companies which are having this kind of dominant market share, they are able to withstand this kind of problems in a much better way. So that is very important. And or the second way to make money is to look for companies which are gaining market share consistently year after year. This is also a big test. If the company is gaining market share, that means they must be doing something much better than their competition. And again, such companies deliver much better stock performance. Basically, we have seen that the mid caps of last 5-10 years, many of such mid caps have gone into now large cap bucket, and that is because of these companies are gaining market share from their competition. And I think such companies also can create much better wealth for the shareholders over a period of time. Second aspect is basically pricing power. This again comes from the dominance, market share dominance, or the market share gains. Those companies can have better pricing power. Along with that, typically to have a pricing power, companies should have much stronger brand, very good distribution, and ability to invest behind business. And such companies, again, for them the growth continues for years, and that ultimately delivers the shareholder returns. So these things are very important to select a company. And there are other financial parameter which one has to look when to judge the business, like cash flow generation, ROEs of the company, margin sustainability, or the variations in margin, etc., etc. I have not mentioned those financial parameters in this slide because I think these are very mundane or like hygiene factors. They have to be there. But some of the softer aspect or these qualitative factors like market share dominance or gaining market shares every year or having that brand distribution or some kind of mode, these factors only ultimately result into those financial parameters, which we can check anytime. So I think getting this qualitative aspect right is very, very important. And when we look at any business, selection is very important, but I think more than that, elimination of companies or elimination of businesses while doing this research is very, very important to avoid blocking capital or avoiding capital loss. So in this framework, basically what kind of companies I don't like are mostly from the cyclical sector or companies which have higher capital intensity. Basically wherever there is high capital intensity, particularly in sectors like say steel, power, refineries, etc., they fund this kind of high capex through debt. And because when the cycle is not in their favor, this debt on the balance sheet can be a big troublemaker. And again, such companies can actually prove to be a big loser of capital. So I'm not saying that companies should not do capex. Capex is required for growth, but very high capital intensity and cyclical nature of business. These are two things one has to be wary of while investing. These are mostly can be short-term or tactical trades rather than long-term holdings in the portfolio. Similarly, government intervention. Many businesses, we have seen that wherever in those businesses, a lot of government intervention happens, or a lot of those businesses depend on getting approvals from government authorities or etc. Those businesses makes I mean the wealth creation has not been superior from those businesses, because whenever that happens, lot of sort of issues crop up in terms of say corporate governance or accounting, etc., etc. So these two things are very important to eliminate companies by and large. I'm not saying one don't have to look at these companies at all. One can make money from these companies as well, but those returns are not I mean, history suggests that returns from these kind of companies are not structural, they are not consistent, they are mostly cyclical in nature. So I tend to invest very little part of my scheme into such companies, and that too with a short-term orientation and not for the core part of my portfolio. So this is on the way to evaluate business. The second aspect is management. I think looking at management is very important for me, rather even more important than business. We have heard Mr. Warren Buffett saying that, or we have read this quote that for him, business has to be great and he can do with a dumb kind of management. In my case, I think I will give higher importance to management than business, because we have seen in last 10-15 years that managements can create businesses, great businesses. They can. We have seen many turnarounds, how it has happened in case of say many banks or NBFCs, etc. in last 10-12 years. So the management can change the picture altogether. And similarly, even a solid business, and if the management is not good enough, those businesses can go down under. So I think management is very important. What management is doing, how they are dealing with the changes which are happening, and those changes are nowadays very frequent and lethal. So very important to have this aspect in place. So obviously there again are a lot of subjective factors to judge management, like the competency of the management or the honesty or integrity of the management. Along with these two things, I think what is also important is the capital allocation decisions, because this is one objective factor which we can look at while judging the management. If the management is not managing the episodes of greed and fear in a better way, I think that is the wrong capital allocation. And we have seen that whenever there is good cycle in the economy or market, maybe sectorally, etc., at those times many management go for expansion plan, looking at that time outlook, and the outlook invariably changes, cycle change, and because they invest at those peak of the cycle, they land up in trouble when the cycle turns. So one has to look at, and also in a opposite way, when at the bottom of the cycle, many management actually go in some kind of a shell and then do invest in the business. So when the growth comes back, they are not able to capture the growth. So how the management is managing these episodes of greed and fear is very important. As I explained, investment framework helps investor in terms of managing the episodes of greed and fear. Similarly, management should be doing that. There should be to a limited extent, there should be a contra thinking in that management process, that at the peak, they should not be overdoing things, and at the bottom also, they should not be fearful of investing into the business. So this is one aspect of capital allocation, when to invest. Second aspect is how they are investing. So generally, as I mentioned in the at the opening again, that I believe that one person or one company can have expertise in one or two areas or adjacencies. So they should focus on getting better and better in that aspect rather than trying to do various other things. So in that, with that sort of thinking in mind, I generally don't like companies which are into multiple lines of business, where management keep on incubating newer and newer businesses in one single company. I think those kind of companies don't create wealth for shareholders, because many a times the management might be thinking, his management thinking might be completely different than the investor thinking. Management might be taking 15-20 year call. They might be taking those calls to start new business for their next generations, etc. Or they may just be getting driven by the greed at that point of time. Like now this, so we have seen in the last cycle that when the wind power was in place, many people were going after wind energy. Now solar is the buzzword now. So many groups are going into solar power, etc. So those kind of management we have to avoid. Also, what happens is when they start to go in for a new business, typically these businesses take long time to break even or start making money. So they have to keep on funding the losses of the new business. So the overall company's cash generation and ROEs take a beating. And when they are funding these new business lines with debt on the balance sheet, and if the venture doesn't pan out, the overall company can get into problem. So we have seen that many examples from the past cycle of 2005 to 10, many groups entered into non-core areas like ownership of power plants, airports, roads, etc., and then they landed in a lot of trouble. So I think it is better to stay invested into companies which are focusing on one or two business line or adjacencies and deepening their moats, growing their market shares, or increasing their margins rather than trying to do different things. And if at all the management want to do new business, I think that Tata Group a good example that they are doing a lot of businesses, they are into multiple businesses, but they are doing it through many companies, and I can decide which company I want to buy rather than buying a company which is full of multiple businesses and where one business can go through a good cycle, other business might not be in a good cycle, so the stock can actually go for a long period of hibernation. So there can be absolute loss of capital, or there can be a lot of opportunity loss, in the sense the stock price may not move for long period of time. So capital allocation is very important aspect when you judge the management, apart from the other two factors of competency and the integrity of the management. Another slightly important factor is capital dilution. Management should be, by and large, should be averse to capital dilution, because growth is there for everybody, particularly in India. There is a lot of opportunity to grow, but it is very important for the company to grow with the internal accruals or through the cash they are generating, rather than taking money from the market time and again. Because company can grow, but if that growth is funded through equity dilution, the number of shares keeps on going up and the per share wealth creation takes a big knock. So very important to look at management or eliminate management which are okay to dilute their equity base frequently. So this is a sure shot recipe to not make good wealth over a period of time. And last thing is, obviously execution is very important through tough time and bad times or good times. How they manage the company, that is also covered by the competency factor, so that is very important. Last point is, to make money is growth. Growth creates further growth or attracts further growth. So it's a growth ultimately creates the consistent and sustainable kind of wealth for the shareholders. And I think it is better to identify companies which are into virtuous cycle of growth, because when the company is growing, they can invest after brands and they can expand distribution, they can hire better talent, and all these things can further get growth. So it is a virtuous cycle of growth, and such companies create wealth. Opposite to that, if the company is facing a lot of challenges in terms of ability to grow, their ability to invest in business gets compromised, because advertising, again, brand building, distribution, or hiring better employees, etc., gets compromised. And if you're not able to do these things, invest in business, you can't get the future growth that way also. So it's very important to identify company which are into this kind of virtuous cycle of growth and stay with them, because we have seen again in last 10-15 years, if everything is right and the company is growing, you can't sort of imagine at this point of time how big the company can grow, or how big the wealth creation can happen from such companies. Because as they say, compounding is the pet wonder of the world, and this is really very important in terms of looking for companies or businesses which can create wealth. So these are the three things primarily I look at while identifying the companies. Some of them I already mentioned, what kind of factors I look at while identifying and buying businesses. And I mentioned about the structural improvements in business in terms of brand building, advertising, investing in the brands, distribution expansion, etc. So those I have mentioned. Also very important when I mention management factor is the adoption to changes. So management should be able to, or there should be competency to understand the changes, adapt to those changes, and actually use those changes to their advantage. because we have seen again, particularly I will give example of last 3-4 years since the start of demonetization. There was demonetization, then there was NBFC crisis, GST was launched, and then ultimately we got hit with the COVID. So during this, so these 4 years were very, very challenging. So the companies, and also coincidentally, the technology change was, was happening in a big way. So companies which were able to adapt to these changes and prepare their companies, they are now much ahead and they are looking much stronger to capture the growth which will happen in probably next 5-10 years. So their market share can grow meaningfully because they have prepared their companies looking at those changes. So I think change is a constant in this world, and it has become even much more sharper in last 3-5 years. So it's very important for the companies to have management which can identify those changes or new trends, adapt to those new trends or changes, and prepare their companies. So from that aspect also, it is important to stay invested into good quality companies which are run by very efficient management. Because if any company is not adjusting to the changes, they can their business strength can get deteriorated very sharply compared to the past. I mean, in the past we have seen that even if the companies were not bringing in changes, or they are late in bringing in changes, they could have survived for some period. But in this new world, that period you get to prepare yourself and for the growth or the changes is shortening. So it's very important to have good management running the businesses. So that is important. And some of the quantitative factors I already mentioned, that one obviously has to look at the ROEs, free cash flows, etc. I have covered that in the later slide also. So these are those factors. Cash conversion, generally I look at cash flow from operations to EBITDA conversion. It should be like 50% at least for the non-financial companies, because when the cash conversion is higher, the company can keep on growing without raising money from the market. And that's what I mentioned, that management should be averse to dilution, because when you grow through dilution, the per share wealth doesn't grow up. So this cash conversion is very, very important. Another problem, if the company doesn't have good cash conversion, is they have to resort to debt or loans, and sometimes that may not be a good sign, because times keep on changing, and if the cycle goes out of favor, the companies can land up in problem if the balance sheet has a lot of debt. So that is importance of cash generation. Capital allocation, cost structure. I think ROC is a good measure to judge the companies whether the capital allocation is going right or the cost structure of the company is efficient. As I mentioned, some companies go for non-core or non-related area expansion, or they go into areas which are sort of non-core to the company, or they try to expand at the peak of the cycle. When everything is good, they want to grow, and obviously when cycle changes, they land up in trouble. And if you look at last 5-10 years, if the company has been able to deliver good ROCs, say 12% is kind of a threshold, that means by and large we can look at that they have taken better capital allocation decisions. So ROC is important from that perspective. 12% is a number which has come up because looking at the cost of capital in the country. So that is, I think, important to have more return on capital employed than 12%. For financial companies, the metric is different. It is ROA, return on asset, and generally to make money in financials, 1.4% or more return on asset is important, because for financial companies, capital is the raw material. For growth, they need to have certain minimum level of capital, and companies which are having ROAs more than, say, this threshold, their capital requirement is lesser to that extent, and because of that they trade at higher multiples. So their dilutions are less frequent than the companies which are having low profitability, and we have seen again that the money has been made in those cases. Dividend yield, I think generally this is a hygiene factor. That's what I mentioned, more than 0% dividend yield. That means the company is making some cash or generating cash, and secondly, more important, they are willing or there is intent to share that profits with the shareholders. So I think first test, dividend paying company, uh, this parameter highlight two tests. One, the company is converting cash out of the profits, and second, the promoters or the management has intent to share that wealth with the shareholders. So both things are important. Growth, as I mentioned, I stress a lot on growth, virtuous cycle, vicious cycle. I think 15% by and large is a good number to make superior returns from the market. Valuation, as I mentioned, I don't look at or don't give a lot of importance to valuation. The starting point for to analyze any company is basically business and management. And if these two things are not in place, there is no need to look at valuation. If you buy any stock because it is cheap, there are 90% there are chances that you will meet up with the accident or you will not make money. So that's my learning on the job also in last 10-15 years. So valuation, I have just given this threshold that the payback ratio should be sort of greater than 1, because if the company is growing at 25%, that means in 3 years its profit will double. And even if the company's PE is 25, that means you can get back your money in 3 years, assuming the PE sustains. So this is the importance of this valuation ratio. But you don't give so much importance to valuation. I will rather give a lot of importance to business and management. Quality, again, as I mentioned, the quality factor gets captured into the business and management part. This is one quantitative parameter to look at. Generally, stocks or the companies which are good quality, they generally tend to be more consistent or less volatile than the market, and which can be captured through the beta, which should be less than 1.05. That means those businesses are less volatile or the stocks are less volatile, which is obviously outcome of a good quality business. So these are some of the quantitative parameters which we look at while judging a business. Then in terms of portfolio construction, again, here also I think one should have a framework rather than trying to capture all trends which are the hypes in the market. In my case, I make sure that or try to follow that 80% of my portfolio is into good quality companies, which I have mentioned earlier. 20% of the time I look at some of the tactical short-term ideas or turnaround cases, like currently the steel cycle is very good. So I might look at a steel company from that perspective. So I may buy at a price and sell at a price, but these short-term ideas are restricted to 15-20% of the portfolio for me. I don't want to make it big part of the portfolio because those are typically there is some amount of momentum or speculation involved in these ideas. We try a lot to differentiate between this momentum and the real turnaround. But nonetheless, these stocks are mostly from the cyclical sector, and I don't want to expose the portfolio to these kind of sectors or stock beyond the threshold of this 20%. Diversification also is important to me. There are a lot of favor concentrated portfolios or focused portfolios finds from a lot of investors. But I think, as I mentioned, every individual has his own style or thought process or framework. And for me, this kind of diversified portfolio, having 60-70 stocks in the portfolio, works very well. India has a lot of sectors, themes, stocks to stay invested, and in that way we can reduce risk and capture more and more opportunities also. So I think this is again the part of my framework. And in terms of sizing, again, in terms of flexible or the portfolios which are diversified in nature, generally I like to have 60-70% large cap stocks and 30-40% mid cap stocks. Again, there is no exact science, but this has worked for me in the past. I think this kind of mix in the portfolio gives much better risk-adjusted return. Large cap provide consistent, stable returns, and mid caps can add alpha from time to time. So I have kept that 10% limit for me to for that variation between large and mid cap. Again, last 6 months has been very good for mid caps, as we have all of us seen. But again, mid caps are typically have higher beta than the large cap or the market, and they tend to be very volatile. So it's not that because market is following or favoring mid caps, you should go to like 60-70% of the portfolio should go into mid cap. That is a sure shot again way to get into trouble. So I think this is a better way to create a risk adjusted return for me, and that has worked. And as I said again and again, it is very individualistic. One has to find what works for himself or herself and follow that religiously. That's the way to create long-term wealth. There are other parameters, and I have mentioned that. What about valuation? I have mentioned that it is very important to get comfort over the business and management first, rather than looking at cheaper stock. You can buy those cheaper stock, but then you have to rely on many things, and probably that turns out to be a wishful thinking in long period. 2-3 out of 10 cases you might make money in such cheap stocks, but for that you have to wait long, and in 6-7 cases you have to incur losses also. So that is the pitfall from that kind of strategy, which doesn't suit me. It may not suit many people. It can suit many people, so they can follow that. What to do in correction? So correction is a way of life in market. We cannot wish away correction. They will be there. And I think having a good quality companies or good businesses in the market is in the portfolio is the way to deal with corrections. Because when market fall for whatever reason, say 30-40% fall in the COVID we have seen, if your business is good and company is good, I mean, they have been time tested, at those price fall, you can buy those companies. If you are sitting on a say mediocre company, if it corrects by 50%, at that point of time, you will not find courage to buy at those 50% fall, and you will miss the opportunity, or maybe that can turn out to be a right decision because the company was mediocre. So to benefit from the frequent corrections in the market, it is very important to be in the right stocks. Then only you can take advantage of those dips or correction. Next, when to book profits in such stocks, because if you are investing into good quality companies which are growing, it is advisable to ride those businesses and the stocks for long period of time, as long as possible. Because as I said, to what extent they can go and what kind of business they can transform into, one cannot imagine if everything is good. So till the management is not making a mistake in terms of say capital allocation or other things, and if the business potential is good, I think one should stay invested in such companies, even if it has become like 2x, 3x, 4x, because it can go to become 10x, 20x in 10-20 years. So I think it is very important to stay invested and avoid those short-term temptations to book profit. One can do that at the margin, or maybe 5%, 10% of the portfolio, when you see very good opportunities with the same characteristic company. If the same characteristic company you are getting at lower valuation, then one can look at switch. If you are not getting such alternative and the existing holding is doing well, it is better to ride. Again, there is saying by Warren Buffett that it is better to sort of, one should not weed out the flowers and keep on watering the watering the weed, something like that. So I think it's important to ride the company which is doing well. Next is where do we expect returns to come from? I think returns come from growth and good quality businesses. I have explained it again and again in this. I mean, in my life, in career also, in this PPT also, I have mentioned that I think returns come from the compounding of profits, and the compounding of profits comes from the good businesses and the good management. Alpha comes from, again, higher growth rates, and when the company is gaining market share, I think that is the case where most of or you can make superior returns. So I think these two things are very important, growth and market share gains from the competition. So this is the way I think I look at businesses or companies while selecting stocks. And I will stop here, and Shikhar, we can take questions here on.
Okay, thank you so much. Actually, Atul, I have a little bit of presentation myself. I'll finish that, and then we'll take questions, right?
I will stop sharing from my end.
Yeah, please. All right. So, hello everyone. Welcome to Ab India Karega Invest. I will very quickly walk you through the product, the offerings that we have. I'm mainly here to answer your questions about Groww, about the platform, or the offerings that we have as an app, as a website, and a platform as a whole. Before that, I'll very quickly.
Hello, Shikhar, can you hear me? Okay, I got a message that Shikhar is joining. He is facing some network issues, but he's joining back. Let's wait for just 1 minute. Shikhar, you are on mute. Yeah.
Yeah. As you already know, signing up on Groww is incredibly easy. You can use your laptop or your smartphone to sign up. It's you can use your you can use your uh, laptop or smartphone to sign up. It's 100% paperless, and if you haven't gotten your KYC done, we'll get it done for you. The biggest change that we had recently that many of you might have seen, at least those of you who have the Android app would have seen this by now, and those who are using an iOS, almost all of you would have seen it now. So what the old design had was at the bottom you had Explore, Dashboard, and You. And in the new design, instead of that, now you have stocks, mutual funds, and gold. And within each page, you have the Explore and Dashboard. So this we did because it makes it easier to have many, many more products, which we at Groww will keep on introducing. So this is what the mutual fund screen looks like. You have the Explore tab and the Dashboard tab. Right at the top, you have the search bar where you can type any mutual fund, any stock, etc., ETF, whatever you want to search. Below that is a design that you'll are very familiar with. You have popular funds, collections, and so on. And likewise, you have the stocks page where you have the Nifty, Sensex, and then you have stocks and so on. And likewise, you have the gold page. So moving on from this, the other parts of the app are more or less exactly the same. You have mutual fund, you have this mutual fund page, which does not have any major change in it. All possible details that you as an investor might want to know, you will find here without any issue. Likewise, the stocks page has all the other details about a stock, P ratio, 52-week high, 52-week low, all of those other details, revenue, quarterly reports, numbers, and so on. All of those you'll find here. And likewise, you have the gold page where you have the details of this digital offerings metrics, like you have purity, the minimum amount to invest, the how many carats the gold, digital gold is, and so on. In mutual funds, you can invest one time or monthly. You have both options. It's not like you can, once you start a monthly SIP, you cannot do one time, or vice versa. You can do both. You can even start multiple SIPs in the same fund. You can invest one time in a fund that you have as SIPs running already also. It's very flexible. This is the dashboard screen. This screen contains contains your mutual funds, the one that you have invested in. So on this screen, you can see there's a list of all the funds. And if you tap on any of these mutual fund options, you'll get this screen where you can redeem, which is take out, or you can invest more. If you tap on more details, you'll be taken to a page which will contain all details of your transactions with that mutual fund. So it's like a passbook. All the times you've withdrawn, all the times you've invested, the NAV values, the date, the average NAV value, folio number, all of those details will be there. Import and switch, very important and very popular feature on Groww. Import is basically a feature that allows you to get your mutual funds from other platforms onto Groww. So let's say you had been using some other platform and now you want to use Groww. You can import them so that all your mutual funds are in one place and you can easily track and see your investments. Switch is something that allows you to switch from regular plan to direct plan. So if you were using some other platform or had been investing using some other source, chances are that that mutual fund is a regular plan mutual fund where you are paying a commission. When you switch to direct, you stop paying a commission. There is no commission involved. That results in higher returns for you. So first you have to import, and then you can switch. It's again, to import, you have to go to your dashboard on the mutual fund screen and scroll to the bottom. Right at the bottom, you have the import option there. Groww Digest weekly and daily. This is a service that we started a couple of years ago. This is a newsletter that you receive in your email, and we send it Monday to Friday and on Sundays. And this newsletter contains it contains news Monday to Friday, and on Sundays it contains other content that you as a new investor would love to read. It is very basic, it is jargon free, it's simple, it's light, easy to understand. So, and by the way, if you have signed up on Groww, you're automatically getting these. You don't have to do anything extra to get this in your email. In case you're not getting it in your email, do check your promotions folder or spam folder. It might be coming there. And if not, you can always go to this link and read the digest. It's called groww.in/digest. For any other requests, any other queries, any other doubts, please email us at support@groww.in. And apart from this, if you have any other, any place you might be getting stuck, you can go to the help and support section within the app and the website. And most questions get answered there. But in case that doesn't happen, you can raise a ticket, and via that, you can reach out to us via call, via chat, and via email. Please follow us on social media: Facebook, Twitter, LinkedIn, and YouTube. YouTube is one of the most, one area where we concentrate a lot. YouTube, in our YouTube channels, we have multiple channels in various different languages. On our channels, we try and put content that helps new investors. So if you're a new investor, please do give the YouTube channels a look. You might find it, I feel sure that you will find it very useful. With that, I come to the end of my presentation. Now we'll start taking questions from all of you. Just one second. Yeah. So, Atul, I'll let you know the questions. So, first question is one of the most popular questions ever. Everybody wants to know this, which is how to look for multi-bagger stocks.
Right. So yeah, it is everybody's desire or dream always to spot the multi-bagger stocks, and in that, following that wish or desire, actually, a lot of stocks take away the wealth. But anyway, I will try to answer this. I think there are two ways to get these multi-baggers. One easy way, I think, to spot this multi-bagger, given you have a long time horizon like 5-10 years, is to invest into, as I said, good quality companies having strong moats, like good brand distribution and ability to invest in technology and all those things. And second is execution from the management. So like we have seen in some of the private sector banks, some of the NBFCs, some of the consumer discretionary company like pen companies or or say like consumer durable companies, etc., etc. So those kind of businesses, they become multi-bagger for sure, but over a period of 5-10 years or even longer. So in the sense that every year, if the company is growing at say 20% or 20%, that means every 3-4 years the bottom line will double. That means in 10 years it will be like 8 times bottom line. So that is the way to get one multi-bagger, which is very good on the risk reward framework. Second way to spot multi-bagger is to look into what they call is finding sort of multi-baggers from the kachra. Like the companies which have gone down so much from the cyclical sectors, like we routinely get these stocks come up on the screens, like from the sugar sector or tea sector or those things, or metals. Because of the cycles, they go to a bottom, like, and because they have already, they also typically have debt on the balance sheet and many other problems. But when the cycle turns, those stocks goes up like 4-5x. Like in the last 1 year, we have seen the metal stocks have become 5-6x from those oversold levels. So these are the two ways to look at the multi-bagger. One is the slow and steady kind of way, and second is the look out for those oversold stocks. But I would say the second way to look at multi-bagger is very, very risk prone, and there are also chances of losing money. So I think I would prefer the first way, and I have explained in a much detailed manner while going through the PPT.
All right, great. So the next question is how to analyze a stock for long-term versus short-term. What extra points to analyze? So, I mean, first of all, I think one question that we can get out of the way is that should investors, at least in equity, be looking at short-term also? Because there are many people who suggest that when you invest in equity, go only long-term. But so do you suggest that retail investors try out short-term investing also? And then if yes, then what are the different strategies?
As I said, I mean, I don't rule out any way to make money. The objective is to make money. There can be various ways to achieve that objective. So it is okay to look at short term also. As I said, for 20% of my portfolio, I also look at some of those turnaround ideas, or where the management change is happening or cycle is turning for good. You can look at exposure into such companies with 3-6 months perspective. You can buy at a price and sell at a price. But then you have to look at 10 other things, how the balance sheet is there, whether there is huge debt, I mean, whether the debt is manageable, whether the incoming management is of that quality where you can bet on that new management to capture low-hanging fruit and turn the company around, etc., etc. So we have to look at a lot of aspect when you look at those short-term ideas, because there is a high risk in those ideas. You can sort of lose money in those ideas also. And it is very important when you go into such ideas to have a target in mind to exit, because people generally keep on riding the stocks, and because they are prone to cyclical, they're prone to events and all. Like today, we have seen incidentally the crash in the metal space. So it is important to have targets in mind to exit and keep on booking profits in those short-term ideas. I think when you talk about long-term, that is the ideal way of investing. And I would say large part of the portfolio, I'm not saying 80 is good, but for myself, I have devised that 80-20 rule. One can have 60 depending on the risk appetite, but large part of the savings should be in those long-term compounding ideas, and some money you can keep aside to capture the short-term turnaround ideas or cyclical plays, etc., or thematic funds, etc. So I would approach the market this way rather than be with one side.
All right, great. We'll move to the next one. Which are the sectors good for investments in the next 3-4 months? So this viewer wants to know what is better for 3-4 months.
Yeah, I think 3-4 months is a really short term in the market, but I think at this point of time, I will tell you that in my fund, I am overweight on banking and finance and cement and some of the auto ancillary companies. These are basically these are basically economy related sectors and not maybe tech or export related sectors. I think over a period of maybe 6-9 months, these sectors will do very well as the economy picks up after this COVID and all opening up happens. And the valuation in this side is actually pretty reasonable compared to their own history as well as the overall market. So I would say if I want to pick up one sector, that will be banking and finance.
This is actually not the question that the question that I'm going to ask is not something the users have asked. It's just after this question, I feel like asking you, what is the minimum duration for which you have invested in a stock for? So I'm not talking of trading, but as a general practice in your portfolio, what is the shortest duration you have invested for?
I think the shortest duration, if I can remember right, was around say 3 to 4 months. 3 months I had made money and exited that kind of stocks. I mean, it has happened last year only during COVID. When the COVID hit, one retail company, the stock price just went down. And though I don't like the retail business because it doesn't generate cash or the ROEs are not good, etc., and they dilute capital. But at that point, I thought there is no, the stock, there is a lot of bearishness or pessimism in the stock. The franchise is developing well. So I bought that time around say June, July, and by Diwali, when after the first wave, the opening up happened, the stock just bounced back 50-60%. So I thought it's a good time to exit. So yeah, I think I don't remember anything doing is below say 3 months.
But so yeah, when the opportunity arises, you can. So if you know what you're doing, you can seize the opportunity. That's what you're trying to say.
Seize the opportunity and with limited capital. I'm not saying putting 10% in that one stock. I will just put in 1.5%, and we can play with such opportunities.
But again, I'm sorry, I'm dragging this one question, but this is one of those topics that can get discussed a lot. So I just want the viewers to have absolute clarity on this. How often would you say such opportunities arise? Because when you say, let's say you have invested for a minimum of 3-4 months, there might be viewers who might think this happens very often. Like every month there is stock. So how often does this happen? Not
so it happens actually. It is happening in last 1.5 year actually, because there is so much volatility in the market. At the market level, there was volatility, and the sectoral level also there is a lot of volatility. We have seen rotation in sector, one sector doing well, other sector not doing well. So these opportunities are coming in a much higher degree in last probably 1.5 year. Generally, as I said, I will look at the frequency of such opportunities rather than the frequency of opportunities, rather than how much money I can put behind such opportunities. I think if there is no such opportunities, I am happy taking that core holding to 90% also. As I mentioned, 80-20. But if I'm not getting any idea in that 20, it is not compulsory to find out because this basket is anyway risky. So if you don't have margin of safety on your side, is not advisable to invest just because you want to maintain that proportion.
Okay, great. Next question is how to analyze a mutual fund before investing for the long term.
Yeah, I think it is very important. People or the advisors obviously look at the long-term track record and the dispersion of returns and various other measures. But for a fund manager, those are outcomes, or even the return the scheme delivers is an outcome. What we look at is, what goes in the fund is basically what kind of stocks we are buying, companies we are buying, and the growth potential. So I think it is important for investors to look at the framework the fund manager is following, or try to at least understand the fund manager's psyche or thought process. Whether he is kind of a jumping jack, he want to be master of all trades. I think that is not the ideal way to, invest your money yourself also. And because as I mentioned, anybody can be expert of one or two areas, and he cannot capture all rallies. Last year we have seen many rallies, sub-sectoral or mid-cap, large cap. But if one try to capture all those things, he will surely land up in problem at some point of time. So it's something important to follow or understand the fund manager's psyche or thought process, and whether he's following that. If the investor's time horizon, thought process, or the likings are aligning with that fund manager's thought process and the portfolio, it is ideal to invest into such funds for at least 5-10 years kind of horizon. So it gives better consistency. I mean, obviously market will go through ups and downs. The various styles of investments will also go through ups and downs. Like in 1 or 2 years, value can do well, and other years growth can do well. But if you are familiar with the style of the fund manager, you can stay invested. You can cope up with that underperformance in a much better way, and you can avoid taking wrong decisions at wrong point of time, which is the way to create wealth. So I think it is important to look at the fund manager's thought process and whether the portfolio is aligned, because by and large people are aware of the companies which are there, and through the glancing at the portfolio also they can come to understand whether he likes the companies or he don't like the companies, rather than just looking the past 1 year or 3 year number, because that number is just a number and it will keep on changing. I think it is important to go one level deeper in terms of looking at the portfolios and the kind of companies the fund is holding.
What is the best way to invest in volatile markets?
I think see, volatility was there in the past, and we have seen last 1 year was the best example of this volatility, and it will be there in the market as long as market exists. Volatility will also be there. Again, I would say it is very important to have or decide asset allocation depending on your individual goals, needs, suitability, etc., and stick with that asset allocation and keep on rebalancing using this volatility. I mean, if the market corrects by say 10% and your equity allocation was 50, it will come down to 45. It is important to take that 45 to 50 again in that market correction, so that when the market recovers, you benefit fully. If you don't rebalance and remain at 45, you will participate lesser to that extent. So I think it is important to have allocation and use volatility to sort of get benefit of this equities or averaging out equities at those kind of volatile markets.
Okay, that was the last question for the day. Thank you so much for coming, and thank you everybody else for joining this session. Next week we'll be back with another theme, another AIKI, and we'll have another guest. And hopefully very soon we'll see Mr. Atul again in one of our sessions. Thank you so much for joining us, Mr. Atul.
Thank you, Shikhar, and thanks, Groww, and happy investing to everybody.
Thank you.
Thank
Goodbye.
you. Bye.